Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Eric Lutton, who's the Chief Investment Officer at Sound Income Strategies. Eric, great to have you on the show.
Thank you for having me.
Absolutely. So, Eric, so much action in the bond market right now. It's all anyone can talk about. What the heck is going on over there? We're seeing rising recession fears, and yet yields on the 10-year and the 30-year bond are spiking at the same time. Should we be concerned?
Yeah, it's been a pretty crazy week. One thing we've definitely learned this week, in simple terms, cash is king. I can't stress enough, especially since we're not allowed really to go to cash. We have a low cash mandate because we're paying out dividends every couple of weeks. So a lot of funds have low cash mandates, and so they may run to T-bills or treasuries. But when stress like this hits the market, as we've seen of late, you can get whipsawed even in government debt. So it's not just spread product that can get knocked around. Like you said, the long end of the curve and the belly of the curve, the 10-year touched off, I believe, Monday morning at pre-open about 106, which is about a 390 yield. And by Wednesday morning early, the 10-year was down to 101, a price of 101. So that's about a 4.5% yield. So basically a 60 basis point swing in about a 48-hour period due to the tariff headlines and the tweets. So it's been pretty volatile. But that's where I think moving to cash and money market securities, even for a short period of time, can really make you look like a genius by lowering your drawdown potentially at the end of the year, having better looking Sharpe and Sorrentino ratios, and giving you an opportunity to buy on dips or buying good securities on sale. So find a good quality money market security with decent yields can be a real strategy. If you're just parking funds to avoid some massive volatility, it can come in handy. Granted, this might be more helpful to individual investors versus managed accounts or ETFs, but I would say never underestimate the value of cash in times of distress because, everything's pretty highly correlated in black swan events. So, except puts maybe.
Yeah, definitely. T-bills and things like that have been the place to be. Do you see value in the longer end of the curve? The 30 years almost 5% now. Do you see
Yeah,
opportunity there?
there could be. You just have to be careful. For us, our products tailored more towards, I would say, end clients. So we have to be careful about how much duration we're taking on because we do have preferreds in the portfolio. So we kind of watch that. I don't want to get too far out in our bond portfolio in the long end, but that's kind of where we watch it. But I would say it's you just have to be careful. I mean, a lot of insurance companies are out in the long end of the curve. It's a lot more volatile because there's a lot less supply. So if for whatever reason you stop seeing potential buys in that part of the curve, it can get whipsawed pretty quick.
Right. So now I want to turn to your ETF, Eric. It's called the Sound Enhanced Fixed Income ETF, ticker symbol FXED. This uses what you call a blended corporate credit income strategy. Can you tell us what that is?
Sure. It's fixed income. It's the income world is pretty big. So you have traditional fixed income based securities, where you'll have preferreds, U.S. Treasuries, agencies, mortgage-backed, municipal, and investment-grade corporate bonds. That usually makes up a core foundation of fixed income portfolios and funds out there. However, there's other income-generating assets that aren't represented by the famous Bloomberg bond aggregate, which I'm sure you've heard a lot about as a benchmark for fixed income. Bonds like high yield, sovereign debt, business development companies, REITs, MLPs, master limited partnerships, CDOs, collateralized debt obligations. Then you have various closed-end funds and interval funds, along with private credit, that all kind of fall under non-traditional or what some people call unconstrained fixed income. The whole other non-traditional worlds is worth taking a look at, and we have in our ETF if you want to lower your portfolio's overall risk and kind of increase your income. Each of these has its own merits. It just depends on the goals and needs of the end client.
Can you tell us a little bit about the categories of assets that are in this fund?
Sure. For instance, for our fund, we have obviously corporate bonds. We have investment grade and high yield, a mixture. Because obviously those are fixed, and along with preferreds, we've added in business development company and REITs, kind of in sovereign debt, kind of in the non-traditional category. And the reason being, BDCs are kind of like non-bank banks. So when interest rates, if you noticed, when the Fed was going through their tightening phase, interest rates were going up. So fixed income normally gets hurt. Well, BDCs help out because it's floating rate loans. So if we're looking at a bunch of floating rate loans, obviously that's going to help us in increasing interest rate environments, hence higher dividend payouts for us. And REITs, to some degree, have baked in 2 to 3% increases in their master lease agreements. So that also helps out when they're every year, or when these leases are coming due, that brings in more income to the lease management companies, obviously because their leases are resetting. And it's provided they're resetting at 2-3% higher rates, that also adds in an increasing interest rate environment. So those all kind of help us out.
So it certainly sounds like there's an eclectic mix of assets in the ETF, Eric. What kind of risk, reward, yield type of characteristics does this fund have?
Well, I mean, we're not set necessarily to a specific benchmark like ag, even though everybody wants to see it and it's performed quite well versus the ag. But we're really kind of our history to describe why we have an eclectic asset class in this fund is because when we started in 2015, David, our founder, David Scranton, for Sound Income, he and the advisors were looking for 5% plus in yield. And if you remember 2015, we're at zero interest rate environment. So I was like, well, so you want me to make up a high yield income fund? And like, no, we can't have all high yield. You can have some high yield, but we need to figure out how to make it better. And I said, well, this is going to lead us to non-traditional. So this means BDCs, REITs, BDCs for the floating rate component, obviously, and REITs, and sovereign debts. Simply because we just needed to get more yield, and with traditional, treasuries or investment grade bonds, we were going to be sub 5%. So this is where it's kind of helped us. If I stuck to more Bloomberg bond aggregate, the ags, I think about 44% to U.S. treasuries and agency debt. So it's kind of limited.
And finally, Eric, this is a very interesting fund. Where do you think it fits into a portfolio, and what type of investor should consider adding it to their portfolio?
Well, I think for retail investors that they're not going to, sometimes retail investors are do-it-yourselfers and they'll pick some hot stocks, some momentum stocks like NVIDIA. Well, when it comes to fixed income, most retail investors aren't going to do credit research. They're not going to go through the K's and Q's and look at the ratios to determine is this debt safe or not. They might glance at the ratings and that's about all they'll do. So where this fund comes in is we've tried to, you could buy all the ingredients at the grocery store to make a pie, sugar, flour, fruit, or you can buy kind of one of our frozen pies that we've already put everything together for you, just kind of pop it in the oven. So we're trying to have a higher yield than most traditional and trying to get a nice blended mix. So that way on the downside, we have a little more lower correlated assets so we don't have quite as big a drawdown. Because I believe in 22, if you remember, where the S&P had a drawdown, I think about 24%, the ag had about an 18% drawdown for the year, and most non-traditional assets had a much lower drawdown, 8-9%. So if we can get lower drawdown, add some non-correlated assets or low correlated assets, lower our risk and get a higher yield, that's what makes the case for our fund, I think.
And I'm looking at your website right now. It looks like the yield is around 6.5% right now. Does that sound right?
Correct. And
Fantastic.
obviously, in an environment, and we make the proper trades and adjustments, hopefully we can get a little bit more than 6.5. We'll see how the year plays out. Obviously, tariffs are throwing a monkey wrench into markets right now, so we have to be careful. But hopefully, this will all get settled soon, and we'll see some countries sign some trade agreements, and things will settle down, I hope.
Absolutely. Well, we'll continue to follow this ETF closely, Eric. I want to thank you so much for taking the time to speak with us today.
Thank you. Thank you for having me.